Did you know that saving and investing aren't the same thing? And choosing the right strategy can make all the difference for your financial future. While saving helps protect your money, investing can help it grow. In this video, we'll break down the key differences between saving and investing and show you when to use each strategy to build wealth and secure your financial goals. Before we get started, don't forget to like, subscribe, and hit that notification bell so you never miss more valuable financial insights. Let's dive in. 5. Purpose. Saving serves as a financial cushion for short-term needs. Its primary purpose is to ensure that you have liquid funds available for immediate access, whether for an unexpected emergency, a large purchase like a car or vacation, or short-term goals such as buying a new appliance or furniture. The key focus of saving is stability and security, where your primary goal is to preserve your principal and avoid risk. Saving ensures you have immediate access to funds in case of an emergency or for planned expenditures that you expect to make in the near future. Investing, on the other hand, is designed for long-term wealth accumulation. The aim of investing is to grow your money over time through assets like stocks, bonds, real estate, or mutual funds. While investing may involve some degree of risk, it offers the potential to significantly increase your wealth, especially when compounded over many years. Common long-term financial goals that benefit from investing include retirement, funding a child's education, or purchasing a home in the future. The purpose of investing is to build wealth and generate returns that outpace inflation over time. 4. Risk level. Saving is considered very low risk as it focuses on preserving the principal. Savings accounts, certificates of deposit, CDs, and money market accounts are typically insured by government agencies such as the FDIC, Federal Deposit Insurance Corporation. In the U.S., this means that your deposits are protected and you don't risk losing your money, even if the financial institution faces difficulties. The trade-off is that savings accounts and other low-risk options offer low returns, which may not even keep pace with inflation. Investing inherently involves a higher level of risk, but it also presents a higher potential for reward. The value of stocks, bonds, and other investments can fluctuate due to a variety of factors, such as market conditions, economic changes, and company performance. While past performance shows that investments generally provide higher returns over the long term, they also expose you to the risk of losing part or all of your invested capital. The greater the risk, the higher the potential for return, which is why investing is best suited for those with long-term financial goals and the ability to withstand market volatility. 3. Time horizon. Saving is typically for short-term financial goals. You would save money for needs with a short time frame, such as a few months to a few years. This could include saving for a down payment on a house, a vacation, or setting aside emergency funds. The goal is to maintain liquidity, so you can access the money quickly without penalty or loss. Because of this short time horizon, savings accounts are preferred, as they offer a high level of accessibility, even though the interest rates may be low. Investing requires a longer time horizon, often 5 years or more. The objective of investing is to allow your money to grow over time by taking advantage of market compounding. Investments like stocks, real estate, or mutual funds generally perform better the longer they are held, as they ride through market cycles. With investing, you typically don't need immediate access to your funds, as the focus is on the long-term accumulation of wealth. The longer time frame allows you to withstand short-term market volatility and benefit from overall market growth. 2. Returns. Saving offers minimal returns. The growth from savings accounts is typically lower than the inflation rate, meaning that while your principal is safe, the value of your money may be eroded by inflation over time. Interest rates on savings accounts are usually low, sometimes close to 0%. Making it an option primarily for those who need immediate access to their funds. Saving is not a strategy to build wealth over time, but is essential for short-term financial security and liquidity. Investing, in contrast, has the potential for much higher returns. While there's no guarantee that your investments will always perform well, the long-term returns from stocks, bonds, or mutual funds tend to outpace inflation and offer much better growth than traditional savings accounts. Historically, the stock market has provided an average annual return of about 7 to 10% over long periods, far surpassing the minimal growth seen in savings accounts. The trade-off is that the returns from investing are not guaranteed, and you must be prepared for fluctuations in the value of your investments. 1. Liquidity. Saving is highly liquid, meaning that your funds are readily accessible when you need them. Savings accounts allow you to withdraw your money at any time without penalty, making them ideal for emergency funds or short-term goals. If you need to use the money for an urgent situation, you can easily access it without worrying about market fluctuations or the time it takes to liquidate investments. However, the ease of liquidity comes at the cost of lower returns, as savings products are generally conservative and low risk. Investing is less liquid, especially with certain assets. While stocks and bonds can often be sold relatively quickly, other forms of investment, such as real estate or private equity, may take months or even years to liquidate. Additionally, you might have to sell investments at a less favorable time if you need the money quickly, which could result in losses, especially in volatile markets. Investments are meant to be held for the long term, and the value may fluctuate, so it's important to have a clear understanding of the time frame for each investment and your ability to wait for favorable conditions to sell or liquidate the asset. Choosing between saving and investing. Both saving and investing play important roles in personal finance, but the key is understanding when and how to use each strategy. Saving provides safety, security, and liquidity, making it a great choice for short-term goals or creating an emergency fund. Investing, on the other hand, is crucial for building long-term wealth and achieving major financial milestones like retirement, buying a home, or funding a child's education. In a well-balanced financial plan, it's important to use both. Start by establishing a savings cushion to cover immediate needs and emergencies, and then focus on investing for long-term growth. By combining these strategies, you can protect your financial future while growing your wealth over time. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.